I want to go over the introduction to equity valuation, and this will actually be our project. I will provide a full write-up on it as well shortly. And what you'll be doing is essentially creating a valuation for a company and then providing an analysis, a financial analysis and a risk analysis to that company using the modeling as well as all the skills we've learned using NPV. So this is an example I wanted to show. Say there is a business that essentially has earnings for 5 years of 100,000, then it sells, you could sell it for $1 million. What is the value of the business today? So 100,000 in cash flows a year and $1 million on the way out. So what are the total cash flows? These are expected cash flows per year. All you gotta do is discount them. So if the discount rate is 10%, the value of the business turns out to be $1 million. So that would be worth, that's basically what it would be worth today. So, okay, that's obviously, I think, because the discount rate here is 10%, right? And everything kind of turns out perfectly. Now, how would we do the same thing for a company? So, for example, I did an valuation model for Apple, and this is called a residual earnings model. The residual earnings model, basically what it does, it's based on this concept that a company's value is literally its balance sheet value. So this is the balance sheet value because net assets on the balance sheet is literally assets minus liabilities. This could even be cash, so it has to be part of the value because it is right there already. Then what is the remaining values? It's residual earnings, saying that, hey, what a company returns beyond its required earnings. Its required earnings is this right here, basically. So its required earnings is its shareholders' equity times its cost of capital. Basically saying if it's just returning 10% or 13% in this case, then all it should be worth is what it's on the balance sheet, because it's saying that you're returning what your value already indicates on this balance sheet piece. That's what the shareholders are already expecting. Anything beyond that warrants additional value beyond the balance sheet value. This is a very popular model to use. Basically, it's showing you earnings beyond what they call required earnings. And Apple does have plenty of what is called residual earnings beyond required earnings. And from then on, it's the present value of those earnings for the next, say we did like 6 years, 7 years. And then the terminal value is basically the annuity of the piece that comes last, and saying it's a growing annuity at what rate? At essentially the GDP growth rate. That's all it is. So as you see with Apple, the value comes from the balance sheet. The value comes from near future term earnings. So we have the balance sheet right here as a piece. We have the next 7 years of earnings as a piece, but the big piece comes from the growth that is coming from basically projecting next 50 years or so in total value, showing from this model 830 billion. And then on Yahoo Finance, if you saw, basically it is showing 217 per share and 1.05 trillion. So it's gone up a little bit. So you can play with your model. That's what I want you guys to do, is basically adjust the model, make a model for a different company. The way you can do that is get different kind of earnings, get the earnings growth also from Yahoo. That's how you get the future earnings. You can get these earnings from the balance sheet. It's just basically the balance sheet data. You can go to financials and literally look at a balance sheet. The assets minus the total assets minus total liabilities is all I put there. That's how I got it. And then the next one, you can just look at the model. It's basically last year plus earnings. Everything is kind of set up for you there. And you can play around with the numbers. So if the numbers are, you're not getting the right number, you could actually, you can update, for example, the cost of capital, the equity. So what happened with Apple, maybe the earnings growth actually increased. So I know that the stock has been going up the last 6 months, and maybe it's because of the new product and earnings are up now. Okay, so if we do 25% growth, now we're talking 1.08 trillion, which is more where the stock is at today.